Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. Hello, welcome to the BOGART Effect. This is James Bogart. I've got with me today Aleks Spencer, our Chief Investment Officer at Bogart Wealth. Thanks for joining us, Aleks.
Yeah, excited to be here.
You know, this is a little special treat for us. You know, usually you and I are doing our monthly calls, but today we're going to get to talk a little bit about alternative investments. It seems to be the current, let's just say, fad. Everyone wants to be talking about alts, or at least a lot of financial advisors at least are talking about alts. You know, it's one where I think it's all encompassing. There's a lot of different assets that fall into the category of alternatives. And we want to add some context, add some color, and do a little bit of education. So thanks for the time today, Aleks.
Yeah, no, I mean, I think you hit it right on. It's the new hotness right now, and it's certainly the buzz that everybody's talking about, which of course alts have been around for some time now. It's not like there's something new. But I do think it's an exciting conversation. There's hidden value in the alt space. First, I guess let's start with a little definition here. Public markets versus private markets. So public markets, you know, this is stuff that trades on an exchange, stocks that trade on exchange, bonds, New York Stock Exchange, NASDAQ. You see that it's available for everyone versus in alts, you get more sophisticated investors, wealthier investors typically. You have more financial disclosures in the public markets, you know, your quarterly earnings reports. You don't have that in alts. And then it's the illiquid versus, you know, liquid conversation. I think that's the big one altogether. Now, the reason I say hidden value here is because you've seen a trend over time now that more companies are electing to stay private versus go into the public markets. And certainly in small cap space, roughly 85% of companies out there now that have 100 million in revenue or more are now in private side. So that's quite a bit of opportunity. And the number in public side has declined since 1996. You had about 9,000 companies in 1996, and now it's around 5,000 companies, give or take. And then lastly, I would say that unicorn companies, right? So unicorn companies are those with 11% in AUM or more. A billion market cap or more. And you've seen a tremendous explosion of private companies that are unicorn companies. So your OpenAI, SpaceX, Anthropic, all these kind of new and exciting names.
But let's dig into that one a little bit more. So, you know, you said when it's publicly traded, it's on one of the exchanges, it's more liquid, it's, let's just say, more financial disclosure. But that doesn't necessarily mean that they're better companies, right? Like, or even necessarily that they're bigger companies. It just means that they're on an open market and publicly traded.
You know, that's actually an active discussion right now. The president obviously threw this idea that what if we went to semi-annual or, you know, less frequency of reporting? That's been a conversation separate but related. So touching on your point, I think the reason I bring that up is because, you know, when you don't have the pressure to answer to shareholders on such a, you know, quarterly period here, you can focus more strategic. So I would argue perhaps in the private sector, you might have some value there where companies, I mean, you're an owner. What would happen if you can only focus on one quarter at a time versus thinking on a multi-year horizon? That might be something that's worth value added in this perspective.
You know, but I guess it's important to frame the context here. Like when we talk about alternatives, this is almost a $7 trillion market, right? Like this is not small by any means. And a lot of these are investments in businesses that I would argue are kind of some of the lifeblood of the global economy. A lot of them are smaller businesses in nature. As you mentioned, you know, even $100 million in revenue or above could fit into a privately owned category where we don't have to deal with the different, let's just say, regulatory or sequencing environment associated with it. No?
I would agree, and I think that's a good segue into what are some of the different asset classes and sub-asset classes in the space. So first, on a high level, there's four primary asset classes. You have private equity, you have private credit, private real estate, and then you have real assets. When we talk about some of this, so let's touch on private equity to get to the heart of your question. In private equity, you can have sub-asset classes such as venture capital. This is your small companies that are just starting out. Then you get into your growth companies. Growth companies, now you have a little bit more of a track record, a little bit more of a proven results, and you're looking for capital to scale and grow. You can get into buyout companies, your most mature companies. So that's a different phase. And then you get into secondaries. This is just where you're getting into transactions from different fund managers to fund managers in the alt space.
When I hear you mention some of those different types in private equity, what's the implied level of risk within each of the subcategories, right? Like I'm imagining, startups are going to have to be riskier than, say, for example, the secondaries. Is it fair to say that ranking that you just did is the level of risk attribution that I would assign to that in the private equity space?
Yes, I think it is fair to say, because you're basically going from companies that just are brand spanking new, the venture capitals, to your most mature companies in the buyout stage. Now, the secondaries, again, when you're dealing with transactions from fund managers to fund managers, they may deal in different types of securities, different sizes. So risk, though, in this space is really nuanced, I would say. So we got to be careful. The number one goal here, what are we trying to achieve? We're trying to achieve excess returns. And excess returns relative to what? Relative to the market. And what do we know as a market? The proxy is the S&P 500, really. So
You just answered my next three questions, by the way.
Oh, fantastic. Here we go. So S&P 500, annualizes at 10% since inception. And when we're talking about dealing with private equity, you're talking about, call it 15% give or take. So doing better than the S&P. The other group that you have here is private credit. So private credit, you're looking at about 10%, so matching the S&P. But let's remember that you're doing it with debt, so about half the risk in that situation. Now, the other aspect of this that we got to pay attention to is, oftentimes you see folks say there's less drawdown in some of these spaces, or they're not as volatile, which is generally true, but there's a nuance called market to market in our industry, right? So this is how often things are valued.
Or priced.
Yeah, exactly. How often things are priced. And as you're doing this, how often can you look at the computers and all the assets that a company owns? You can't do that real time with alts. So you don't see that pricing as often. So by design, it feels as though the volatility is not there, but don't mistake it. There is risk. And it just depends on which flavor of these asset classes you're doing. Now, the other thing I would say is the return dispersion is huge in this space. Your top quartile names can really deliver solid returns. If we're using private equity, for example, you can see 15 and even higher, closer to 20 plus.
Sorry, when you say returns in this space, are you talking about private credit, or are you going back to a broader category of alts?
Just general in alts. Yes, thank you. So in alts in general, because even within private credit or within private equity or private real estate, point is that in this entire private market space, you're going to have that the top performers are really knocking it out the park. And then your bottom performers, it can vary, right? So the due diligence is crucial.
Well, and I think it's important to align what is the objective of the investor, because you're right. Alts as a category is very broad-based. It's all encompassing. And as we've been drilling into, you got private equity, which has different nuances or different forms. You've got private credit, you've got private real estate, and then you have real assets, right? So when we talk about, and let's drill in, I know we talked about private equity and private credit already, but let's maybe talk a little bit more about the nuances of private credit, because this is one where I think a lot of people just assume credit that's the same as bonds. No, it's not. Private credit has lots of different components associated with how they're lending. And in a lot of instances, the risk is by no means the same, right?
Yeah, 100%. And I'll also add really quickly that in the private equity, keep in mind that you can have your large caps, your mid caps, your small caps. You can have international names and domestic names. So you can have different flavors within private equity, within those subcategories that we talked about, from venture capital on down to your buyouts. Now, private credit, as you mentioned, you're talking credit, we're talking debt, we're talking direct lending to companies. And it's a very income objective here in this case. We're not looking for that equity upside. You also have more speculative pockets of private credit too. So you can have asset-backed securities. You can have distressed debt. You can have capital solutions. So what are some of these things? Capital solutions, it's just flexible financing to some of these companies at different parts of the capital stack. Distressed debt. Now we're talking about buying companies that are on the verge of bankruptcy or some sort of hardship, and you're going in for the opportunity of turning it around. Asset-backed, it's some sort of investment with debt that is secured by something, secured by their inventory, secured by equipment, whatever it may be. So when you're getting into those types of pockets, more speculative transactions, and you can certainly have more investment grade type varieties in there too. So
sure. But I think about distressed debt situations, that's going to be higher on the risk spectrum than anything that is asset backed, right? So, private credit is one where it gets really attractive from a rate of return perspective. Like you'll start seeing yields north of 10%, right? And net to the investor, right, after the manager and the fees and everything else. But I think it's really important when we're talking about private credit to really understand the underlying assets that are associated with it and the level of risk that is being attributed to it. When I think about private credit, there's absolutely a market for it. And candidly, a lot of it is because businesses don't want to have to go to banks or go through a banking process, or they might not even have the time, right? Like I think about like capital solutions. That's always a very creative lending structure for a business that might need short-term capital for a need, whatever it is, right? Like I'll use the tariffs, right? There were a lot of businesses that decided to massively increase the level of inventory they had on file, or specifically increase the orders that they had on file for goods that they needed before the tariffs did. And they were not going to manifest the revenue or profit off of buying those goods for several months. But because of the incoming tariffs that were projected to happen, they massively increased the level of orders. Now, that's great for the businesses that are being ordered from. However, there's a financing piece that needs to be done. That's exactly where I would say capital solutions types of financing is a great option there, because you don't have to go through a banking process. You don't have to go through all of the underwriting components. And especially if you're a pretty well-capitalized business, it's one where you can actually get a relatively decent rate and something where it's short order of magnitude that you need to get the funding quickly. Now, that said, like you talk about distressed debt, that can be highly speculative. That can almost be at the same caliber of like private equity investing in startup companies, right? Like these are usually businesses that are going through very, very, very hard times. Now, the yield that you're going to get off of those is very attractive because of the risk that you're taking. And so the whole point of this little tangent is just make sure that you understand the risk associated with any investment that you're going into. But when we move into this category of alts, which again is a very broad spectrum of category, I think it's extremely important to understand that there's a huge illiquid component to alts. And because of that, you need to be compensated for the illiquidity relative to just going to public equity markets where you can buy and sell very, very easily. But at the same token, there's risk in the underlying assets as well. And private credit is one that I personally am a little skeptical of, just because we're starting to see certain asset classes get a little bit dicier. And yes, the yields are beyond attractive, very attractive, but there's risk associated with it. And so we need to make sure that we're assigning said risk.
Yeah. And again, really quickly on something you said there, this is a space where a lot of capital is coming One, because remember, post-Great Financial Crisis, a lot of the banks had more regulations, so they've kind of stepped away, and you've seen more of this private money kind of come into the space. So that's where also has created some of the growth opportunity. But you're right, risk reward go hand in hand. So that's something that's important to understand.
Well, and so we're going to transition and talk a little bit about real estate, but I've noticed within the real estate space, a lot of builders are preferring to build homes on spec, meaning that they don't have an attributable buyer for that property. They're going to just build the house and then they finish it or get close to finishing and then sell it. But instead of using traditional bank financing, a lot of them are either using hard money lending, so private credit for them, or they get an investor who they're splitting in the economics of whatever the profit is of the development. And so, when we talk about real estate, most of the real estate that sits in the alternative investment space is focused primarily on income. So, think we buy an office building and we develop a pool of investors who are helping and sharing of the economics of that. And then there's an annual or quarterly or semi-annual cash disbursement associated with the rent rates of what is netted out after the building has operated, it's had its expenses, and then the investors get their money.
Correct. And, you're also seeing what's popular is kind of these short-term bridge loans that builders will do, right? So maybe they see an attractive land or some sort of opportunity, and they'll get this private money for 90 days, even at times, just to kind of get the land straight cash, and then they'll find the buyers who ultimately will finance with a mortgage and pay that off. So there's different ways that money can get creative. But as you mentioned, in private real estate, there's direct real estate or there's pool of real estate holdings. It can be equity based. It can be debt based. And you also have real assets. Now, this is kind of, I call it a catch-all because it's just any natural resources from farmland to infrastructure, anything left over, that's what you get in this space.
Yeah. Gold, commodities, Bitcoin, cryptocurrencies, they all fall into that catch-all category.
Exactly. And I think this is a natural place to transition into suitability. I mean, I think suitability is paramount in this space at the end of the day. And the reason why you have suitability is really just so folks understand what they're getting themselves into. So we have some sort of a regulated way to make sure people who can be in this space can truly be in this space. They have the means, they have the ability, or they have the knowledge. And with suitability, you have 3 different levels. There's accredited investors, there's qualified clients, and qualified purchasers. So accredited investors, you set the baseline for this. This is, you're making $200K or jointly $300K, you have $1.1 million in net worth, or you're just an investment professional. So some sort of ability and knowledge. Qualified clients, now that's that next step. Here you're getting to some of the performance-based fees that you can see in the space. Oftentimes for fees, you'll get some sort of a management fee, which can be anywhere from 1.5% to 2%. You can see carried interest. This is after a certain hurdle rate, call it 10%, give or take. The fund company is entitled to get 20% of the returns at that point. Now, the suitability for this group, $2.2 million in net worth, can not include your house, or $1.1 million just with that advisor alone. And then qualified purchaser, this is just about special deals and larger deals, and you're dealing with a $5 million plus in net worth category. So point of all this is making sure upfront that you not only either A, understand it, or B, you have the ability to take this kind of risk on.
Yeah. So I want to translate what you just said a little bit. Basically what we're saying is alternative investments are not for everyone. You need to have a certain level of income or a certain level of net worth. And then once you get to that status, there's differing levels of net worth that adjust the categorization of what you're invested in. I'll tell you right now, I know plenty of investors that have over $5 million of net worth and would fall into that qualified investor category. but have no clue about what alternative investments are, right? Like, so, and by the way, and Aleks will attest or at least validate this, but like, we won't invest any client money at Bogart Wealth that my personal money hasn't gone into. And the main reason for that is there's stuff that we're looking at on the alternative space right now that even I, with a 19-year career, do not understand. And so we're putting me in first so that we can ultimately understand not only the nuances of the investment, how it reports, how it links in with the accounts, what the expectations should be from a client perspective. And it also gives our team the ability to do a little bit more analysis beyond just the periphery level of diligence that they're going to give us before we make the investment.
And I'll tell you, just on the investment team, here for us, as when we were launching the alts platform side of what we offer here, it was crucial that we had to get the education right. It's not only education for everyone in our industry or within our firm, but it's for our clients to understand that everybody knows exactly how it happens, because it can be such an unregulated, such an obscure, there's not a lot of transparency oftentimes. So making sure people understand exactly what it is, but there are great opportunities.
And just when we talk a little bit about suitability, I want to emphasize that alternatives, in my personal opinion, are not for everyone, especially private alternatives that are illiquid. Not everybody can handle having the ability to have a portion of their assets where they can't get access to them for a period of time. And most of the time, the illiquidity is for not months, not even a year, it's years, right? 5, 7, sometimes 5 years, 7 years, sometimes even longer than that. So it's just important to really fully comprehend what is it that you are investing money into? What are the implications associated with it? Just because you have a certain level of income or net worth by no means means that you are affluent in this. I remember very vividly interacting with an advisor at another organization I won't name, but it was one of the wirehouses. And he was making a recommendation of a tremendous amount of private credit and structured notes, which I would say, we are very well versed in it. And I asked him, I said, are you disclosing to the client the commission that you're getting paid on this investment? And his response to me was, no, I don't need to because they're an accredited investor. Well, I'm sorry, that's not the right answer in my opinion. And so my purpose of even sharing that story is just to make sure as a investor, you understand all of the elements associated with the investment that you're going into. Going into this realm of alternative investments is, and again, it's the new fad. It's where everything's, a lot of the chatter is around alts. And I do think that it serves a purpose and it serves a place for certain types of investors, but it's not appropriate for everyone. If you're going to put investments into it, you really need to make sure you understand all of the nuances associated with said investments. All right, Aleks, what else do we want to make sure we hit today when we talk about alts?
Yeah, I was just going to say, really quickly on the different types of structures that are out there. One thing I'll say is because it's become so popular, because everybody's talking about it, everybody's finding a way to kind of democratize this and make it available to everyone, which is good and bad still. We just need awareness around that. So I think traditionally, most people know the traditional drawdown structure. This is your 10-year lockup. You put some money in, there's capital call downs, there's some sort of a vintage investing phase.
Explain, what's a capital call down?
So when you're getting into a private equity, in a traditional structure, you don't right away put all your money into it. What happens is the fund company will call capital down. That's what's happening. And they'll call certain amounts at a time as they find companies to invest in. So they'll call, over the first few years, little increments at a time. Then there's usually a period where it's invested into these companies and they're turning them around or whatever it may be, depending on the strategy that you're in. And at some point, they start to sell these companies and harvest the gains and start to distribute money back out to you. And that's why there's a 10-year lockup. Now, there's been different flavors of this, people getting creative on how to make it more accessible. such as interval funds, for example, or tender offer funds. This is a situation in an interval fund. It acts like an open-ended meaning like an ETF or a mutual fund where you can put your money in any day, daily, right? So they will always take your money. So that's a guaranteed in this space. Now, how often can you can you redeem your money? That's the question, right? So in an interval fund, it's periodic, usually quarterly, something like that. And the difference between an interval and a tender offer, they're the same really, but in an interval fund, they have to provide at least 5% to 25% redemption on every one of those periods. In a tender offer, same thing, they'll take your money daily. However, they have the option to redeem if they have that available. That's the tender. They tender to buy your shares back, but they don't have to. There's a board that kind of determines this. The difference in the two, why would you pick one or the other? I would say in a tender offer fund, they can have more ability to truly get into some private kind of companies and stay a longer period without that pressure of having to meet that liquidity. Whereas in an interval fund, because they have to by law meet potential redemptions of 5 to 25%, they may keep some money in public markets to meet liquidity as needed. So you don't get that full exposure. Still a good option, but just different ways that they're kind of giving you exposure, but there's always a trade-off, right?
Well, and with each of them, there's an additional fee structure associated with it as well, right?
100%.
In a lot of instances, they're investing in these private equity or private credit or alternative strategies, but then they have to be paid for their overhead expenses. So you can have costs on costs on costs. And so that impacts your return, right? So most of the time you don't necessarily fully see the costs, but it's coming out of the net return to you as the investor. But no, I think, and then even recently too, like there's separate account managers that are now getting into this space. There's ETFs that are getting into some of these alternative strategies as well. So now you're losing some of that let's just say associated risk with illiquidity, because you're now able to have more direct access to those types of strategies. However, again, comes at a price / a cost, right? So just important to understand all of the nuances of the investments that you're investing in.
Yeah, and if nothing else, just take that this is an acquired taste, number one, and make sure that you also just do the due diligence, the homework. It's a great opportunities out here. As mentioned, more companies are staying private. You're seeing some of these large companies, OpenAI, SpaceX, all these. So there are great opportunities here that you don't get in the public space, but one just has to make sure that they do their homework.
Yeah, and I think it aligns with your overall long-term goals and risk profile. And I think if you can't gather, but Aleks and his team at BOGART Wealth, we are looking very aggressively at alternative strategies and how it's appropriate for integrating into our client portfolios. We're putting our money where our mouth is and making sure that it's appropriate along the way. And not every one of our clients it's appropriate for, candidly, but there are a portion, subset of our client base that it's absolutely something that we need to be integrating into the overall investment strategy. But happy to be a resource. Hopefully this was educational and enlightening. Thank you for tuning into the BOGART Effect. The previous presentation by BOGART Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from BOGART Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither BOGART Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if BOGART Wealth is engaged or continues to be engaged to provide investment advisory services. BOGART Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if BOGART Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of BOGART Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.